New states join, but economic collapse looms. The economy is thriving with growth in factories, roads, canals, and banks. But there's a dark cloud on the horizon, a financial crisis that'll rock the nation to its core, the Panic of 1819. In 1819, America was still young, just 42 years old after winning independence from Britain. The country had grown by leaps and bounds since then, with new states like Ohio joining the Union in record time. But growth wasn't without its costs. Back then, banks weren't tightly regulated as they're today. They issued more paper money than they had in gold or silver reserves, causing an excess of currency in circulation. People believed that economic growth and prosperity were limitless. Suddenly, though, things took a turn for the worse. In 1819, an economic panic hit hard. Banks started failing left and right, one after another. The crisis spread like wildfire across the country. Why? Because when banks issue more money than they can back with real assets or sufficient reserves, it's only a matter of time before financial instability ensues. Understand how severe the situation became. By 1820, nearly half of all banknotes in circulation were rendered worthless due to widespread bank failures and economic instability. Imagine going to the store with crisp new bills only to find out they're no good. That's exactly what happened back then. This crisis wasn't just a bump in the road. It was America's first significant economic downturn, often referred to as its first Great Depression. Now let's look at the numbers. In 1819, before the panic hit, banknotes had a face value of $30 million. But when you factor in how much actual gold and silver they represented, their real worth, that number dropped to just $15 million. So nearly half of all paper money was overvalued. That's a big deal because banks relied heavily on these notes for everyday transactions. When the value of these notes declined, it disrupted trade and commerce nationwide. Factories shut down, crops went unsold, and workers lost their jobs. This wasn't just an economic hiccup, it was a full-blown crisis that affected every sector of society. Here's another critical number. Before the Panic of 1819, there were approximately 300 banks across the country. But after the panic struck, more than half of those banks failed or closed their doors. That's over 150 financial institutions vanishing in a matter of months, a staggering collapse that left many people without access to credit or savings. People discovered that their savings were practically worthless as the value of money plummeted. This meant that despite saving for years, individuals found their life's work erased in an instant. The Panic of 1819 devastated families and communities, leading to widespread poverty and economic hardship. So why did this happen? One major reason: the War of 1812. The government needed cash fast to fund its military efforts, so it turned to banks for loans and encouraged their expansion. Banks responded by issuing more currency than they could back with specie, gold, or silver, leading to inflation and devaluation of paper money. When people realized that their paper currency was worth less in terms of real value, confidence in the banking system crumbled. Another factor was the disruption of international trade. The Napoleonic Wars severed many of America's trade routes with Europe, resulting in an oversupply of goods and declining prices. American merchants faced challenges due to decreased demand and intensified competition. On top of that, there was rampant speculation on land, particularly in newly admitted states like Ohio. People purchased vast tracts of land, expecting rapid appreciation and immediate wealth. However, when the Panic of 1819 hit, land values plummeted, leaving many individuals heavily indebted with little to no means of repayment. All these factors combined to create a perfect storm for disaster. It wasn't just banks and investors who felt the impact. Farmers, workers, and everyday citizens also suffered. Economic activity declined significantly as consumer spending decreased. Many factories shut down, businesses went bankrupt, and unemployment rose sharply. Let's look at some real-life examples. In Philadelphia, one of the largest cities at the time, over 40 banks shut their doors during this crisis. That's nearly half of all financial institutions in the city vanishing overnight. People who had saved money saw it evaporate as worthless paper. Imagine losing your life savings because a bank couldn't back its notes. Now let's talk about what happened next. Congress and state legislatures tried to stabilize things by passing laws that limited how much new currency banks could print. But this wasn't enough to stop the panic from spreading. It took years for the economy to recover, with recovery not coming until 1827, 8 long years later. During that challenging period, many Americans faced severe difficulties. People lost their homes and savings quickly due to financial instability. Numerous businesses failed, leaving employees without jobs or income. Farmers also suffered as they struggled to sell their crops at reasonable prices amid the economic decline. Here's a concrete example. In Kentucky, many farmers struggled to pay off loans on land they had purchased during the boom period before 1819. When crop prices fell due to oversupply and reduced demand, these debts became impossible to repay. As a result, people lost their farms, which was heartbreaking for them and devastating for their communities. Another key player in this crisis was Andrew Jackson. He became a hero during the War of 1812 and later, as president, fought against what he saw as excessive banking practices that contributed to economic instability. His efforts led to reforms aimed at preventing another crash, though these reforms did not fully take effect until decades after his presidency ended. But why does this matter today? Understanding how America's first major economic crisis, the Panic of 1819, unfolded provides a historical blueprint that can help us avoid similar pitfalls in the future. It highlights the dangers of unchecked banking practices and underscores the importance of strong regulations to prevent another financial panic from occurring again. So what's the lesson here? The Panic of 1819 was a stark reminder that unregulated financial systems are prone to collapse when banks overextend credit and issue more currency than they can back with specie, gold, or silver. It highlighted the need for robust oversight and clear rules in banking to protect people's savings and maintain economic stability. In short, the Panic of 1819 demonstrated that without proper regulation, the economy can be susceptible to sudden shocks and instability, a lesson that remains relevant today. This is educational and historical, not financial advice. The Panic of 1819 exposed the severe consequences of speculative lending. Banks issued loans for land speculation in Western territories without adequate collateral or oversight. People borrowed to buy land they did not need, assuming its value would rapidly increase. However, when the bubble burst and land prices fell sharply, many farmers and investors lost everything. Imagine a farmer taking out a loan for $1,000 to buy 640 acres of farmland in areas westward expansion reached during the early 19th century. The bank approved it because the land seemed valuable on paper. But what if that land turned out to be less productive than expected? When crop prices fell and debts mounted, many farmers were left with nothing but empty promises from banks. The ripple effect was significant. As people defaulted on loans, banks demanded more collateral, leading to a vicious cycle of defaults and foreclosures. Panic ensued as depositors rushed to withdraw their savings from the bank, only to find that much of it had been loaned out or invested elsewhere, often in non-liquid assets. This crisis also exposed the fragility of international trade ties. The US was heavily dependent on British imports and exports at the time. When Britain experienced an economic downturn in 1815, which lingered into the early 1820s, demand for American goods dropped sharply. Suddenly, our export markets dried up, leaving many businesses without revenue. It's like if your biggest customer canceled all their orders overnight. Moreover, the Panic of 1819 highlighted how quickly confidence can evaporate when there's no trust in financial institutions or government support. People stopped lending to each other because they feared accruing bad debts, leading to a severe credit crunch that choked off economic activity and growth. The collapse also had long-term social consequences. Thousands of farmers, workers, and small business owners lost their means of earning a living. Many were forced into debtors' prisons or faced the shame of bankruptcy. Communities suffered as there was virtually no social safety net in place to support those in need. One particularly harsh example is how many families turned to charity just to survive. Soup kitchens and food banks emerged across cities like Baltimore and Philadelphia. It's sobering to think that a nation built on independence and self-reliance had to rely so heavily on handouts during this crisis. The Panic of 1819 also spurred the first major wave of political activism centered around economic reform. People demanded changes in banking laws, tighter regulation of financial institutions, and better protection for consumers and workers. This led to the creation of new government agencies like the Bureau of Statistics, established in 1849, and influenced the rise of influential politicians who championed economic stability. In short, the Panic of 1819 is a cautionary tale about the risks of unbridled capitalism without proper oversight. It demonstrates that while innovation and risk-taking are crucial for economic growth, they must be balanced with prudent regulation to prevent devastating financial crises like this one from recurring. The lessons learned then remain relevant today as we navigate our modern financial landscape. This is educational and historical, not financial advice. The Panic of 1819 highlighted the vulnerability of a young nation's economy to global market fluctuations. American banks had extended substantial credit to finance European wars and industrial activities, leaving them exposed when those markets collapsed. This led to sudden specie shortages, widespread bank failures, and deflation. Farmers and manufacturers faced severe challenges as prices fell sharply while their debts remained fixed. People faced difficult decisions during the Panic of 1819. Some lost their homes or farms due to foreclosure, while others turned to bartering goods instead of using cash for transactions. In cities like Philadelphia, soup kitchens opened to feed those in need. The economic downturn highlighted deep societal inequalities between the wealthy few and the many who were struggling. Politicians debated solutions. President James Monroe proposed reforms but faced criticism for not doing enough. Congress formed committees to study financial issues and propose legislation, yet powerful interests often blocked meaningful change due to self-interest. This cycle of boom and bust would continue throughout much of the 19th century until significant reforms were implemented during the progressive era in the early 20th century. The panic's legacy endures today in debates over banking regulations, stimulus packages, and economic recovery strategies. Its lessons underscore that while innovation and growth are vital, prudent oversight is also essential to protect ordinary people from catastrophic failures. The choices made during the Panic of 1819 set a precedent for how we address financial crises now. Tomorrow on the Money Files, stock market seasonality and investor behavior. This is educational and historical, not financial advice.